I would like to talk a little bit more about research on the effects of audits. And then I have prepared a few slides on how data analytics more broadly can be leveraged in tax administration. So this is going to be the big topic of our upcoming conference and so on next year. But I think since we touched upon these issues over the past days, I thought it would be nice to follow up on this a little bit. Wait, not quite there yet. Two more insights I wanted to share with you on the effects of audits. One is a more systematic analysis of the effects of different audit types. So remember I said in the beginning that the United States, but many other countries as well, are shifting more and more away from traditional face-to-face audits towards correspondence audits. So today, what do you think in the United States? That's maybe a question for you to get back on board here. What do you think? Which share of their audits are conducted via correspondence in the United States? So, of all the audits that are being conducted, how many of those are face to face and how many of those are correspondence? Any guesses? 20 face to face or 20 correspondence? 20 face to face, 80 correspondence, yeah? 1% face to face, okay. Bold prediction. What would the others say? Somewhere in between or 7% face to face, 93 correspondence? So I don't have a graph on this, but you are very close. So 20 years ago, 80% were face to face, something like this, and 20% were correspondence. Today, it's the other way around. 85% are correspondence and only 15 are face to face. So if one has followed the current administration's approach to the IRS, one might easily come up with one potential explanation for this, which is the budget has not been increasing in the Internal Revenue Service of the United States. So they must find ways to cut costs, and obviously correspondence audits are much, much cheaper than face-to-face audits. But there's, of course, other reasons as well, including increasing digitization and just a streamlining of processes. In this study here, we wanted to understand better what are the compliance implications of those two different audits. So all of my talk has been about audits change behavior, have the potential to change behavior, and thereby raise revenue going forward. But I also mentioned this survey we conducted a few years back in the US, where we found that many people who had a correspondence audit did not recall having a correspondence audit. So then the question arises, well, if people tell us, no, I haven't been audited, should we expect them to be still afraid of the tax administration and increase their reporting levels? Or is it that face-to-face audits are much better at inducing behavioral change and raising revenues going forward? And this nice colorful graph here plots the results of audits, of correspondence audits up here, and face-to-face audits down here. And you see different values in here. In yellow, you see the tax that the taxpayer reports. And we repeat this exercise for many, many years. So we estimate effects of audits in 2010, 11, 12, 13, 14, in all these years. And we look in yellow at how much tax do taxpayers report. How big is the adjustment? That's in green. How much additional tax does the IRS identify? And then in blue and purple, how much do audited taxpayers change their reporting in the years after the audit compared again to matched unaudited counterparts? And we distinguish between these two audit types, correspondence audits and face-to-face audits. But we also distinguish between what we label here early and late cycle audits. So in the US, maybe not just in the US, there's often a backlog in how many cases they can audit. So if they select a case for an audit, they will not necessarily audit the taxpayer before he or she files her next tax return. But in many cases, you file for tax year 2024, and then the audit will only happen in 2026 or 2027. But in the meanwhile, you have filed some more tax returns, right? So it's important when trying to evaluate the effects of these audits, it's important to take care of when did the audit happen and in which year should we see a change in behavior. If you file 2024 and 2025 and 2026, and then you're audited for 2024, then of course we would not expect 2025 and 2026 to be affected by the audit because you already filed these returns before the audit started. So this is what we refer to here as early and late cycle audits. So it seems from looking at the data that especially for correspondence audits, the IRS targets low-income taxpayers for early cycle audits. So early cycle means you file 2024, the audit starts of your 2024 return, and only then do you file your 2025 return. So you should see a behavior response already in the next year after the audit year. And so by comparing the size of the yellow bars here for different early audit cycles, but also between the audit types, you see these are much lower income taxpayers than in all other cases. So what the, yeah?
There's a question from the online participant from Timor-Leste.
Great.
Mr. Costa asked us, according to your experience, face-to-face audit and correspondence audit, which one is more effective? And please, can you share your experience regarding with it?
Thank you. Wonderful question. I hope after I'm done explaining this graph, the answer will be more clear. So that's what I'm trying to explain to you in this graph here. So, but I'm starting the answer with saying that this distinction which we made here seems to be important, because if we threw them all in one pot, if we would not distinguish between early and late, we would not see that the IRS really focuses on a specific subpopulation of taxpayers here, which are low income taxpayers. And one issue with those particular taxpayers in this case is they often claim the earned income tax credit. So that's a tax instrument in the United States that's supposed to be a subsidy or, better, a tax credit to people who work but who earn low levels of income. So they can claim a tax credit, a tax rebate to save some money. And so many of those people qualify for this. And there's a lot of abuse going on, at least this is what the administration suspects, but also a lot of errors there. People might claim this credit, but they might not be entitled to it. And we believe this is what explains this. But it's not so important, it's not so much about what explains this, but just to be aware of this. The other important thing to take care of, so we've noted already that audits not always increase compliance. In some cases, compliance goes down. And remember that the blue and purple bars show the change in compliance in the first 2 years after the audit. So blue is 1 year after the audit, purple is 2 years after the audit. But you see here, these colors are missing. They're not entirely missing. If you look very closely, you see they're very small, but they're also negative. So what this means is for correspondence audits that happen early, so before you file your next tax return, the compliance response again is negative. These taxpayers become less compliant, so to say, through the audit. Whereas in all other cases, in late cycle correspondence audits, as well as all face-to-face audits, the compliance response is positive. So people report more. And so, getting back to the question we heard from the internet, our takeaway from the orbit in Timor-Leste, our takeaway here is that face-to-face audits are more consistent in generating future revenue, in changing taxpayer behavior so that compliance increases. But the important thing that we are not factoring in here, at least in this graph, is you of course need to balance the revenue you gain against the cost of the audit. And I have a graph on this a little bit later. So correspondence audits are much, much cheaper. So you cannot simply conclude from this that the administration should only conduct face-to-face audits because they generate more revenue, because of course the important bit is also that they're much more costly to perform, and that simply you might not have enough auditors to perform these, right? If 85% of all audits are of this type, you would have to hire a lot of new personnel to replace this. Or alternatively, if you cannot do that, then of course you might have other effects. So we talked about if the overall number of audits goes down, then non-compliance might rise as well. So or will most likely rise as well. So it's really not that straightforward, and there's a lot of moving parts here. And this is why I think it's very important to make good use of data to actually try to understand better what it actually is that's going on there. But again, the takeaway message here being that both on average have positive effects. We estimate here, and this also goes back to the question, we estimate here that on average, the compliance effect is twice the size for face-to-face audits than it is for correspondence audits, but both do have positive effects on compliance. And again, whether or not you should do more of type A or more of type B really depends on your country characteristics as well. And finally, this is something I discussed already a little bit with the colleagues during the break. Remember, we did this study where we compared the effects of different audit selection mechanisms. So we found that when people know they have been randomly selected for an audit, their compliance goes down, whereas when people know they have been selected for an audit because they have been less compliant or reported lower amounts of income than the others, then compliance goes up. And what we wanted to understand better is, why is this? Why would the taxpayer after an audit become less compliant? Could it be that they believe they're unlikely to be audited again in the future after they just had an audit when the audit was random? So there's a large literature, I'm not going to detail here, but that has investigated the behavior of gamblers in casinos. And what we've learned from this is there's a lot of fallacies, a lot of mistakes people do in estimating probabilities. So if someone plays roulette, for instance, and we know each throw is independent of the other, and it has been 3 times red in a row, for instance, then many people will falsely believe, now we've seen red so many times, black has to be the next color to win. And a similar result seems to be, or a similar pattern seems to be happening here. So what we did in this study, and I think this is quite a clever design, someone asked, how exactly does this work? So we cannot in the field introduce variation in the audit selection mechanism. At least we didn't find a tax administration who was willing to let us really look into different reasons for being audited and communicate that information to taxpayers. So what you do when you set up a lab study is you invite a group of people. Here we had real people, not just students, which is often the case. And you simulate a tax filing decision. So you bring them to a computer, you describe to them a scenario and say, we give you income, and we want you to declare your income in a tax return. We cannot observe your income, but there's some probability that we are going to check if what you say is true, just like in the real world, right? And then we provide financial incentives to make it so that their decision in the little computer game they're playing aligns with the incentives, with the structure of the decision they face in the real world. And then they play this repeatedly. So in round 1, you get 2,000 income and you decide how much to declare, and then you learn whether or not you're audited. In round 2, you get 3,000, and then this changes a bit, and let's say you play this 10 times. And some of the times you'll be randomly selected for audit, at least in one of the groups. So in this group, we told them the probability that you will be audited, you can report whatever you want, but there's a 10% random probability that you're going to be audited. And after we told them this, we asked them 2 questions. One, out of your income of 2,000, as an example, how much do you declare? And the second question is, how likely do you think you're going to be audited? And the important twist was we paid them extra. We told them the audit probably is 10%. Then they moved to the next screen. We asked them, how likely are you going to be audited? You can say an exact number or an interval if you're unsure, but we pay you an extra bonus, a few dollars, $2 or $5, I don't remember exactly, if you get it right. Okay, we provided a financial incentive for them to think about how likely it is they're going to be audited, when we thought it was also not very, very hard. Computer screen 1, just 2 sentences, one being there's a 10% of being audited. On the next slide, how likely are you going to be audited? We'll give you $5 if you tell us the right amount. But what we found, interestingly, when people were audited, they estimated that the risk of being audited again when audit selection was random, when there was a random 10% audit probability, was 4% lower. So on average, despite being financially motivated to come up with the right amount, they said, well, after I've just been audited, there's just a 6% risk of me being audited again. So this seems to be a very strong behavioral bias in people, that they have a hard time taking these independent events of being audited this year and next year, when it's truly random, to be independent. They think it's not independent. I've been audited in the past, so now I'm safe. My chance of being audited again drops. And I think this is a very good explanation for the decline in compliance that we see. So people appear to have the tendency that they underestimate the risk of being audited again in the future. And again, just like in the graph before, we can ignore this. This is not so important. Like in the graph before, when we had the same setup, but the audit selection was not random, instead, we said it's also 10%, but we're not randomly select 10%, but we're going to select the 10% in your group with the lowest reported income. So the probability was the same, but the allocation of the probability was different. And so people, when you were selected for an audit in this case, you learned, of course, oh, obviously I was gambling a bit too much. I was reporting a little too little income. And to avoid the risk of being audited again, we saw before people increase their reported income, but we asked them, how likely are you going to be audited? And in this case, people upward adjusted the perceived risk of being audited. So they have been cheating. They thought they would get away with the cheating. Then they were audited. And so they learned from the fact that they were audited that the risk of being audited, given their behavior, is higher than what they thought. Okay, so the point here is, it's not only about the objective characteristics of the system. It's not only about how you set up the audit selection mechanism. It's also about what people believe triggered their audit. Why is it that they've been selected? And this determines their compliance, as we saw before, so how much they report, but also how likely they think they're going to be audited again. So with design decisions such as these, you can really influence what people think about the risk of being audited going forward. And I think this is very important, because most taxpayers will not have a clue how likely it is that they're going to be audited. And most people also have a tendency to overestimate small probabilities. So most people will believe that it's very unlikely that they're audited, but they will still be somewhat afraid of the audit experience. Now, if you can change, even if just a little bit, people's perception of how likely they're going to be audited, this is very likely to result in increases in compliance. So that's something to be aware of, that the subjective perception of risk is not aligning perfectly with the objective probability, but that you can use this as a bit of a behavioral lever to get compliance up, these misconceptions in taxpayers. With this, yes, please. You have one there.
So the next question will be should we be transparent with the taxpayer, like why they're being audited in the first place? Let's say if we are being transparent with them, then maybe in the next year assessment they will use another approach to get away from the system.
Excellent question, and I would like to skip this one for now and open the floor to you and hear your thoughts on this. What do you think? What do you think? Should the tax administration be transparent about audit risk, but also the reason for the audit selection? Does anyone in any country use such an approach where you inform the taxpayer about what triggered the audit?
We have, but in general, we recently have reform of our tax audits, and we have issued the standard of practice SOP. And in that, we make it clear that the taxpayer that selected for audit based on risk. So we only made that point clearly. So the different type of risk, the category of risk, the sector that's subject to high risk or something, that based on the tax administration. But the only criteria that we put out and let the public know that you have been selected audit because of your high risk. That's all.
Thank you.
In the case of the Philippines, in the past, we have been publishing the audit criteria in selecting taxpayers to be subjected for audit. But recently, around like 3 or 4 years, we have stopped publishing that because the behavior of the accountants is whenever their clients will receive notices for audit, they would pinpoint to us that which among these criteria does my client belong to, and if not, they would always refute and not refute the audit being conducted by the office.
Yeah, thank you. I think that's a very valuable lesson to be learned. And based on everything we know about incentive structures, this is also, I guess, what one would expect. Once you publicize the criteria you base your selection on, then people will, of course, comply with those, but they will at the same time probably still try to find other domains where they can now cheat more. So I think from this, just one second, I think from what we've learned so far, my advice would be to leave ambiguity, but avoid the impression that you've randomly been targeted. So just say, based on our risk assessment, we're auditing you. So you leave it up for speculation on the side of the taxpayer what exactly it is. You don't give him or her the opportunity to adjust their behavior in a specific direction. And of course, you should protect that secret very well, how you select for audit. I think this much is clear. But I think you also want to rule out the impression that it's just chance. You don't want to give taxpayers the impression that this year I got unlucky and I've been audited. Ideally, you want to induce in them the thought that, well, it might happen to me again. And also, this is a bit linked to what I said before about the audit outcome. So this tendency might be particularly strong if you're audited and they don't find anything. Then these two effects might come together. One is, okay, you believe you're safe now, you're off the radar, so it will be a few years until you're audited again. And the other mechanism might be you might learn, well, the tax administration now knows I'm one of the good guys, I have nothing to hide. So in combination, these factors might explain why compliance goes down. And I think what you would want to do is try to avoid both of them, to tell them, thank you, this was an audit that was conducted based on your risk profile. Everything has been found to be in order, but this does not mean that you might not be audited again in the future, given your risk profile, according to our assessment, does not change. Sorry, this was a long answer, and you wanted to add something to it.
I'd just like to share, in addition to not having to publish the audit selection criteria, the Philippines did release a what we call tagging of taxpayers who are considered CBL. CBL cannot be located because we've seen incidents of taxpayers being audited and all of a sudden they will disappear. So there's a publication requirement to tag a particular taxpayer as CBL or cannot be located. And the consequence of that is whatever assessment made against them will not be covered by prescription rules. So once they reappear, it can be properly served, and we will run after the assets of the taxpayer.
Yeah, thank you. This is, I think, another very valuable comment. So depending on who you ask, the business community might say, well, audits, we always told you they're very harmful, and see these firms go out of business after an audit. So then, of course, one might raise the question, well, if complying with your tax obligation, if the only reason you exist is because you pay taxes, well, maybe you shouldn't be a firm after all. But I think this also touches a bit upon the issues Chris were discussing yesterday, that they might disappear, they might go back to informality, and the question is, will they ever reappear? And at least to the best of my knowledge, maybe Chris can say something about this, but I'm just not aware of any research around this. So this is, I think, a domain which currently we do not have a solid database to inform our decision making, and something to look into more deeply. Maybe, I don't know, Chris, if you would like to add something, and then we have another question here from the colleagues from.
I was just going to say, I think these are really, really good questions that it would be great to work with you to unpack further, right? So, trying to tackle some of these questions in Asia would be really valuable, not only for you right now when you're trying to raise revenue, but also for other countries in the region to learn from you, and I think around the world. So, yeah, these are great questions, and it would be great to work with you on it.
Thank you.
Yeah,
Also, I
and
think-
I just
there-
want to share.
sorry, there was a comment from the Timor-Leste in online. So for Timor-Leste, there are reasons for audit selection. For the random selection, it is to ensure fairness and maintain oversight across all entities, and they do risk-based selection to pick up the companies with high risk.
Thank you. Yeah, I think this is a common and good approach, because again, it also matters which signal you give to the wider population. And if you only conduct relatively few audits, all based around high-risk taxpayers, maybe because you don't have the resources and people know that, then of course many people might feel tempted to not play according to the rules. And so by doing some random audits, you increase the perceptions of real threat of being audited, even though you're not one of those high-risk taxpayers. Now it's your
For
turn.
Thailand, I think for the corporate income tax, according to our law, I believe that we have to specify the reason, like what kind of issues that we ask the taxpayers to correct, or like asking for more documents to clarify the tax return. But for the personal income tax, it depends. And I believe that in the past 5 years, we have the project called the notification letter, or the nudge notification letter. So we do not specify the what triggers audit, but we instead of that, we use a message conveying like we believe that there might be or might not some mistakes in your tax return, and we give you like extra 10 days to correct that. And then we see the patterns of behaviors according to the each type of taxpayers that receive that. But mostly we use that nudging letters to group of taxpayers that we believe that they are non-compliant. And surprisingly, and most of them are like the self-employed individuals, because we lack of data about these taxpayers. And what come after that is that, oh, there is a lot of like reported income tax more than we expected because of that. I just want to share. And I have a question regarding the like previous um the audit cycle. Yes, the late cycle audits and early cycle audits. It's not exactly this slide, but I just have a question whether have you ever considered the timeliness of the audit? For example, in Thailand, most of the audit we did like we have like very late cycle audits. Like for example, right now in 2025, we might audit for the tax year 2021 or 2022, or maybe later than that, like 2020, 2019 or 18. And that would like affect the audit adjustment a lot. But the problem is that taxpayers just notified at this year that they have to pay the tax like for the past year, and they do not like they or might may or may not have ability to pay, and that create the tax debt after that. So right now the tax debt in Thailand is increasing every year, and it's like it's separate a responsibility between the tax auditors and the tax officers who in charge of the tax debt. So we try to balance that because the tax audit need to audit, but because of the lack of data timeliness, or the the audit timeliness is increased more debt. Yes, and right now in Thailand we try to focus more on the ability to pay of the taxpayers as one of the factor that we use to trigger an audit as well. So we see if is this sector is in the downturn economics or something like that, and they may or may not have ability to pay. Maybe we will switch to another sector that have might have more ability to pay, and choose to audit that. Thank you.
Thank you very much for sharing. Two quick responses. One being, I'm not aware of any evidence, speaking to your point of debt accrual over time and increase due to delays, but there are some studies that look at, again, the change in behavior within the taxpayer when he or she has to wait, when there's uncertainty, or when it just takes a long time to learn about the outcome of the audit. And what these studies find is this prolonged period of uncertainty has a positive effect on compliance. So this relates a little bit to the point that you were referring to before, which is how much certainty should you provide to taxpayers. And I think it's a strong, yeah, not only in the tax realm, but in this behavioral research more generally, people don't like uncertainty. And it seems to make them more risk averse and more cautious. And so the research on this particular issue with regard to tax compliance shows that compliance goes up as uncertainty increases. So from that point of view, with some caution, one might argue there might even be upsides to it because it might induce behavioral change in the direction we want to. But then, of course, there's these important side effects that you were referring to. And again, it's, I guess, a question of balance and striking the right um, the right exchange rate, so to say here. And I think one related issue where we also do not have a lot of evidence on, but I think which intuitively makes a lot of sense, that people also care a lot about procedural and the procedural fairness and transparency. And so, if the taxpayers are under the impression that the administration is very bad at doing their job, so you cannot mentally close the case, you're involved in this for a very long time, and you would just like to know the outcome at some point, but they're just not providing a definite answer for a very long time. I think this potentially also might have negative compliance implications, or at least diminish trust in the administration and confidence in their work. So this is, I think, also something to be aware of as one side effect of having a long backlog and having procedural issues like these. Um, Allow me to make one other quick response to your comment, or rather a question. You said with firms, you do have to provide a reason for what triggered the audit. Can you share a bit more about how specific you have to be for that? If, in case you know, maybe that would be interesting for the others here as well. So how much detail do you give them feedback on why it is that they're audited?
I think the reason actually, as far as I know, because I'm not a tax auditor, they have to specify which section of the law that they're using power, and then it might ask the documents regarding the the issues that they found, like the trigger audit. For example, like they have like withholding tax, they claim withholding tax larger than they are withheld, something like that. It's like simple rules which states in the law, and then we have to specify that in the documents.
Thank you. I think for the sake of time, I would like to move on. I really appreciate your perspectives and I really like the discussion. I think this is exactly how we had envisioned this to happen. And I'm very glad to see that we're really picking up the debate here. That's great. But I think we would also like to leave some time for a discussion on how to move forward. So let me quickly walk through these few slides. This is more of an introduction for our discussion to come here, but also to our next meeting. So we touched upon repeatedly. I'm now shifting away from audits and taking a more broader perspective on the use of advanced data analytics in tax administration. And of course, one issue, that's still related to audits, you can use your data to select cases for audits. And I'm happy to talk about this in more detail at some point or hear more about your experiences on this. But you can also, and I briefly touched upon this in the beginning, use data to better understand the network effects of your enforcement effort. So you can analyze data, and I'm going to show you one example from South Africa, a nice recent one, where they used tax return data, so administrative data, to find out how do businesses that are close to a business that is being audited change their reporting in the time after an audit, and which factors determine these compliance responses. One, I think, very nice possibility of making use of data. It might allow you to investigate issues that might not have been on the top of your agenda in thinking about the effectiveness of enforcement systems. But I would like to give you one example from Africa, where they have made use of tax return data to estimate problematic filing behavior. And this results from as they call it, bargaining, negotiations between taxpayers and tax assessors, resulting in tax reports that are good for the taxpayer, but not so much good for the state because people report less than they should. And I think fairly simple and straightforward data analytics can give you a sense of how good auditors are at making their jobs and assessing the taxpayer's true income. But that will become clearer a few slides from now. And finally, I'm gonna be very brief about this, but we've brought this up a little bit already. Taxpayer services, trust, and the rule of data and potentially artificial intelligence in improving this. And I think there's a lot of room for improvement in this domain. I think the bits and pieces are as always a bit more tricky than the big picture statements here, but I think this could potentially also be a very fruitful discussion for us to have to understand better how you can make use of data and potentially AI to improve taxpayer services. Very quickly, so one simple way how data analytics can help, or AI assisted case selection can help figure out who you should audit and how you should audit them. So I mentioned a few times already that more and more resources are shifted towards correspondence audits. And this again is from data from the US, estimating the costs of each audit type. So this is in 2004 dollars, I think, they estimate here, putting together the different components, that each correspondence audit costs around $560, whereas each face-to-face audit costs around $6,500. So face-to-face audits are more than, at least for the US, more than 10 times the price of correspondence audits. And we touched upon this already. One critical question is, which audit type should you use for which case? And how often should you perform correspondence audits relative to face-to-face audits? While this is not an easy decision to make, correspondence audits can be very helpful when there's obvious mismatches, for instance, between between third-party information and self-reported information. So what many administrations increasingly do, they use data analytics and automate this process of comparing what you report to what you have on file for a specific taxpayer. And this, of course, requires some amount of digitization and some amount of data integration, but this can really free resources for other more meaningful taxpayer interactions when you can easily spot mismatches, potential mistakes, or potential indicators for cheating, and then automatically follow up with a letter saying, well, look, we found out there's a difference between what you report and what we have on file. Please clarify. And this might then be the first step in an ongoing audit investigation. I briefly spoke about the network effects or spillover effects, as one might call it. And here's a nice, very recent work analyzing data from South Africa. And they had access to the tax returns of firm level data, all of them in the country, and they were matching this data, pairing this data with information on audits to see if unaudited taxpayers in regional proximity, so close to the audited taxpayers, change their behavior. And what they find is auditing one additional business within a 100-meter radius leads to a 1% increase in compliance. So again, this might not be a very fundamental, very substantial increase, but it's just to make you aware of the fact that audits once more have compliance implications that are not reflected in the direct revenue effects, typically factored in your key performance indicators of the audit function. And then they look in more detail into how does this effect weaken in distance, how long lasting this effect is. So very, I think a very comprehensive overview here on how audits affect the behavior of neighboring firms. Let's use this as the last paper example, which I would like to give you, because I know I've made you go through a lot, and I know it's been a lot of information, but this I particularly like. I think this is a very, very clever and innovative piece and a very nice way to understand data. So I'm going to explain to you what's going on here. So this paper looked at Zambia, data from Zambia. They had all the tax returns from corporate taxpayers there. And as we talked about simplified tax regimes yesterday, Zambia has a simplified tax regime, like many of the countries here as well, we learned yesterday. And I think just like in Chris' example, it's very simple. If you're below a specific threshold, you just pay 3% on gross sales. And now what they have done in this study, so this is the reported turnover here, and I apologize for this being very small. So from reporting 1,000 to, I think, 10,000 down here, it's cut off. And this just is the distribution. How often are these values reported in tax returns? And you see spikes here, meaning that some income level some amounts are reported very frequently, and you see two colors. And so the coloring is the bit more complicated stuff. So let's not focus on that too much. But the color is how much you observe is in dark, and how much you would expect to observe is in yellow. And so if you have spikes like these that are just dark purple or black, we see a lot of these reporting numbers where we wouldn't expect them. And what this means is we see, when just looking at the tax returns, a lot of taxpayers report an amount that results in a tax payment of 50, or report such that the resulting tax they have to pay is 100 or 200, or I think 150 over here. And so with that observation, they surveyed taxpayers and also surveyed auditors, and they learned that taxpayers often interact with auditors before filing their tax return. And what they call this bargaining. So there's some back and forth about how much should I report? What would be an appropriate amount for me to report in my tax return so that you're happy and I'm happy too? And this results in many situations in taxpayers reporting income or turnover such that they have to pay a round number, 50 or 100 or 200. And it's very unlikely, of course, that this is the true income that these taxpayers generated. In contrast, what this indicates is that the auditors push them, or in a negotiation process, in a bargaining process, they come up with a solution that seems to be good enough for the auditor, so he or she has something to show to their bosses. I did bring in some revenue, but also that's acceptable for the taxpayer. And I think it's very clever to think about it this way, because of course, if you think about this at the country level, this showcases how big of an effect such a behavior can have, and how much revenue is lost through patterns like this. So, for instance, what you could do at a country level is produce the same graph at the auditor level. So assuming that over time auditors have a lot of cases, you can use something like this to identify people who have a strong tendency like this. And I'm not saying fire those auditors, but maybe this might flag individuals for additional training, or sitting down with them and reflecting on what the rules are and how they should be implemented. So you could use relatively simple data analytics to get a sense for what is going on, how people operate in the field, and also identify potential problems and improve their targeting of taxpayers and the tax assessments which they generate. I think I'll leave it at this. So there's one more slide, and because I leave it at this because this is something that we'll be talking more about during our last meeting. So there's a lot of ongoing trends on how to use data and potentially AI to improve taxpayer services, for instance. We talked about pre-filled returns a little bit already, provision, better access to information, more transparent procedures, more timely updates, and so on. But again, I think I've been here for long enough, and I've worn you out, hopefully not too much. So let's give it back to Arjun. Thank you so much for paying attention, and also for your great conversations. Thanks.